The U.S. Federal Reserve has put a pause on interest rates, keeping them at a range between 3.5% and 3.75%. Joining us for more is Sam Chai of TD Asset Management. And Sam, when you look at today's announcements, did anything really jump out at you?
So I would say that today's decision for the Fed to hold is a pretty widely expected decision for a few good reasons. For one, the Fed has already delivered 3 consecutive cuts over the past meetings. Policy rate now is currently at 3.75%, and here I quote Chair Powell, is now within the range of estimates of where neutral rate is. So it is like there's no argument that it's now much less restrictive. So a good place for the Fed to wait and see a bit. On the labor market front, we have been seeing some bit more stabilization in data of late. So December job growth was around 50,000, which is a solid data point. Unemployment rate actually went down slightly as well, so it's a good sign. And these are acknowledged in the latest statement as well. Finally, on the inflation front, continue to be steady, I would say. Core CPI is around 2.5 to 3% range, so still above the Fed's 2% target, but nothing too concerning for the Fed as well. So overall, there is no change to forward guidance from the Fed, and expectation is that we could continue to see holding patterns in the near months. There are 2 dovish dissents today from both Governor Waller and Myron, not unexpected by the market. There is this tiny dovish cohort, but more importantly, the bulk of the committee is still with the Chair Powell and prefer to be on a holding pattern right now.
Okay, so given the fact that the economy is somewhat resilient right now, what's the likelihood that we could see a rate cut later this year?
So I think the starting place would be to first for us to revisit where the Fed's forecast of long-term neutral rate to be, and that is currently around 3%, meaning that there's still some room for policy rate to go lower before the Fed starts to be concerned about like refueling upside inflation risk by the monetary policies. And so with that in mind, I see there are 2 paths for us to see more rate cuts this year. The first path is bad news rate cuts. By that, I mean if labor market suddenly deteriorates further in the coming months, we could see rate cuts as early as next meeting or even the meeting after the next, as we know the Fed want to continue to secure the soft landing for the U.S. On the other hand, there could also be good news cut. The Fed continue to expect that inflation will slightly pick up in the coming months, but around end of first half, beginning of second half, we would expect the bulk of the tariff pass-through inflation effect to already materialize. So if inflation at that time is still relatively reasonable, then it opens up room for the Fed to cut further at that time. And on good inflation news. So considering both possibilities, I do see there's a decent chance we see several cuts by the Fed by the end of this year.
Okay, so given that, let's talk about bond yields and what they're telling us about Fed policy, where Fed policy could be headed, especially given the uncertainty around a new leadership for the Fed, as well as the pending Supreme Court decision on tariffs. What are bond yields telling us right now?
So the U.S. rates market currently priced in the first rate cut around June to July, and 2 full cuts by the end of this year. There's no coincidence that the market has priced in the first rate cut by June, because that is also when we expect, to your point, the new Fed chair to come to take the reign for the first FOMC meetings. And market does expect that the new Fed chair will be shifting towards a more dovish reaction function as well. On the second point on Supreme Court rulings, so the Supreme Court ruling is expected to be against the Trump administration's on tariff. Polymarket currently assigned a 70% odd for that. But the market is not naive, right? We know the White House is likely going to find alternative channels to implement their tariff policy. So in the near term, inflation risk remains to the upside. Hence why the market think that it's likely the Fed be mindful of this and be in a holding pattern for the first half and then start to cut in the second half of this year.
Okay, I want to switch to fiscal policy because we've got the One Big Beautiful Bill Act, which is making its way through the system this year. How might that influence the Fed's thinking on rate cuts down the road?
So based on the range of estimates for the effect of the One Big Beautiful Bill, expectations for a roughly, call it 0.3 to 0.5% contribution to U.S. GDP growth this year.
Okay, so there could be a bit of a tailwind there.
That is correct. From consumer like stimulus and capex stimulus. In particular, on the consumer stimulus front, it amounts to over $100 billion and is expected to be pretty front-loaded and acutely felt in the first half of this year. Which is another reason why the market. This is another reason for why the market expect that we can be a holding pattern because of the support for the economy in the first half, and we see perhaps more easing in the second half of this year.
Okay, let's talk about the U.S. dollar, which has had a pretty tough year.
Of course,
it's still under pressure against the basket of currencies. Where do you see the dollar going from here?
Very interesting question. Maybe a bit of context in the U.S. dollar trend as well. So in recent months, U.S. dollar has actually been in a wide consolidation range after have falling materially in the first half last year. But in the past 2 weeks, there has been a lot of volatility to our point, and downside pressure as well. For one, rising geopolitical and policy rates from the U.S. side has refueled this de-dollarization trend. For one, there's also concerns about a potential U.S.-Japan joint FX intervention as well. We also have a rising U.S. government shutdown risk in the moment too. And yesterday, President Trump also commented that he doesn't worry too much about a weak dollar. But then, just like today, Treasury Secretary Bessent mentioned that the U.S. still prefers a strong dollar currency, strong dollar policy. So a lot of dollar volatility there, as you can imagine. Though overall, I would say that we are sympathetic to this bearish dollar theme. And over the medium term, we do see that the risk is skewed to the downside for U.S. dollar on expectation that we could see further U.S. dollar hedging flows, as well as possibly a dovish shift in Fed reaction function later this year.
Okay, now, as you mentioned, there's a lot of noise out there. What are the key indicators that you'll be keeping an eye on in the next weeks and months ahead as the Fed considers its next move?
I think top of mind would be, just the nomination of the new Fed chair, who will be selected, and also if there's any new messages from the Fed chair, because the market is keenly monitoring any shift in Fed reaction functions, going forward. On the economic data front, on the inflation side, expectation is for a gradual rise in inflation, possibly from more tariff pass-throughs. So very important, in my opinion, to monitor the core goods component, which is most sensitive to tariff-induced inflation. So if we are seeing a meaningful reacceleration of core goods prices, that would be, a major unwelcome surprise for both the market as well as the Federal Reserve. And it will really restrain the Fed's ability to dial down policy rate further. On the labor market front, we continue to be in this low hiring regime. So very important to monitor data, including initial jobless claims, layoff data, because if we start to see a consistent pickup in these will be meaningful red flags. And again, a key risk for the market because both the Fed and the market continue to expect a benign macro backdrop right now and is not pricing in that scenario.